Hi guys, welcome back to Money Mindset, the channel that gives you valuable content on wealth, making money, and generating passive income. Be sure to subscribe so you won't miss out on the upcoming videos and grow your own money mindset. In today's video, we will discuss 10 investment tips for beginners from Warren Buffett himself, so sit on tight. The lifetime of Warren E. Buffett has mesmerized people everywhere on the planet for many years. A part of Buffett's mystique is how can someone so rich and intelligent are often so humble, gentle, and generous. By the time Buffett passes, he will have given $100 billion to charities. Buffett is the J.P. Morgan of our generation by showing great strength and courage through the good recession. When the planet stopped and was in shock, Buffett spoke with calmness and rationality. Warren Buffett and Charlie Munger are chairman and vice chairman respectively of Berkshire Hathaway. Alongside his partner, they built Berkshire from humble roots as a textile company to the $70 billion company today in Omaha, Nebraska, Buffett's hometown. Tip number 1. Invest in yourself first. Warren Buffett says the best investment you can make is in yourself. Most people will not make most of their money in the stock market. Their career is also important, so put yourself first. On, for example, Buck Zero, you can find updates from the different markets and also blog content where you can learn more about investing. Definitely recommended. Buffett's business partner, Charlie Munger, had a similar thought. Munger's secret to success: hire yourself for an hour every day and use that hour to improve yourself. Investing in yourself is essential to doing great things and applies to more than just investing. Tip number 2. Diversification isn't always the best idea. Many good investors say diversification is the way to invest within the stock exchange, but Warren Buffett tends to afflict this thought. Warren Buffett suggests diversification is for people who have little knowledge of investment. An experienced investor should select long-term stocks and believe in their investments. Diversification may be a protection against ignorance. It makes little or no sense for those that know what they're doing, says Warren Buffett. Some investors diversify their portfolios for fear that their entire portfolio will sink if stock falls, but it becomes much more difficult to remain the primary target for individual investments. They will reduce the volatility of their portfolio by diversifying, but at the same time reduce their specialization in individual investments. Excessive diversification also means a portfolio is probably going invested during several companies, diluting the impact from its high-quality holdings. The idea of excessive diversification is madness, says Charlie Munger. Tip number 3. Don't invest in a company whose business you don't understand. This is one of the foremost important Warren Buffett investment tips. People invest their hard-earned money just by hearing something good from a few particular companies from others. You'll determine if there'll be any related economic issues within the future by knowing the corporate. Within the stock exchange, there are many firms whose companies are often understood by any ordinary individual. Warren Buffett warns you should never invest in companies you don't comprehend completely. He says that before he invests within an organization's stock, he possesses first to understand within 10 minutes how the company makes money and what the most drivers are that impact its industry. If he's unable to understand it in 10 minutes, he moves on to another company. Most people can't predict subsequent fashion trends among teenagers or whether or not a medicine is getting to achieve success within the market. If you had more data than anyone else, it's still impossible to predict the long run with 100% accuracy. In situations that you believe in an accurate forecast of the long run, Buffett advises not to invest. If it's too complex for you, just look for other businesses to require an edge in. Buffett once said that out of about 10,000 publicly traded firms, he would adore requiring an edge in only a few of 100 companies, before even taking valuation into account. Tip number 4. Trust yourself to be a successful investor. Warren Buffett says that the most challenging thing is to trust your own investment decisions. You usually think that others are right and you're wrong. Instead, you should believe in yourself. To achieve success, you need to beat the fear and not concentrate on what others tell you. accumulate understanding, and make investment choices to be a winner on your own. Tip number 5. Already think like an owner. Warren Buffett always says in his interview, "You've got to think like an owner because that changes your whole views on stock investments." Warren Buffett says if you're getting to own a replacement car, you'll believe its fair valuation, you'll believe its features, and you'll compare it with bikes offered by other manufacturers from an equivalent segment. Then you'll decide which one to get after reviewing everything. Similarly, stocks should have an equivalent view. Tip number 6. Prefer quality stocks to cheap stocks. Many individuals buy stocks simply because they're cheap without understanding that cheap isn't always better. Warren Buffett discovered that buying an excellent company at a good price is way better than buying a good company cheap. Chances of losing money in cheap stocks are very high compared to investment during a fairly valued stock. Tip number 7. Invest without emotions. Some individuals aren't alleged to own stocks in the least because they're too annoyed by price changes. If you're getting to do stupid things because your inventory goes down, you shouldn't own stock in the least, Warren Buffett said during a CNBC interview. Some people aren't really mentally or psychologically fit to own their stock, but I think more of them could be. Buffett said if they were more informed about what they're actually purchasing, which consists of a corporation. Tip number 8. Don't overreact on news headlines. One of the investment tips from Warren Buffett is to not put an excessive amount of stock into each and every news headline that you simply see. Buffett believes within the 99-to-1 rule. Most investors take action to support 1% of the financial news they consume. Doing so, they quickly sell their stocks whenever bad news comes up. For example, a company's revenues have fallen by 10%. If the company during this particular example has been in business for, say, 100 years, then Buffett says that it's definitely capable to overcome the adversity. In other words, people often tend to overreact. As Vanguard's Jack Bogle might say, don't just do something, stand there. Tip number 9. Learn from your mistakes and advance. You might be astonished to know that even Warren Buffett makes mistakes, big ones too, but he makes sure that he learns from his mistakes. Buffett advises keeping a record of the mistakes you've made so that you simply recognize what went wrong and ensure you don't repeat them. Buffett further says that you simply should share these lessons alongside your children and grandchildren so that they know what mistakes not to commit. Tip number 10. Don't be an everyday trader. According to Buffett, the key to getting a much better return on investment is to buy for stock and ditch it. He believes in having a buy and hold mentality and insists on holding stocks for several years. There are two principles behind this. If you buy a stock for less than its true worth, its price will eventually converge with its intrinsic value. If you buy an exquisite business, the price of that business will compound and increase exponentially the longer you hold on there. So the patient investor will ultimately be rewarded if they hold on to their stocks for an extended time. For Buffett, time is the friend of an exquisite business. If you aren't willing to possess a stock for 10 years, don't even believe owning it for 10 minutes. He says that if you constantly buy and sell stocks, it'll deduct an enormous percentage of your returns within the type of trading commissions and taxes. So it's better to purchase excellent stocks and holding them for an extended time. Well guys, that was it for today's video. Many thanks for watching it. Let me know how you liked it in the comments section below. Also, make sure to subscribe and stay tuned as I bring you more money mindset content. Hope to see you next time.